American University in Bulgaria.
Basically, where we kind of like left before the break was we discussed the principal component analysis, that is a method to find latent variables, latent factors in data, and we discussed that we start with just rotating the data and then we select only the most prominent factors that come out of it and treat the rest as residual. But in this procedure, we kind of assume that there are actually as many factors as there is original data. So if we have n equities, we have n factors, and we just leave some of them behind and not consider them, which can be viewed as a shortcoming. And there's actually a way to actually build a model. It's called statistical factor analysis, statistical factor model, that specifically looks for a given number of factors in the data. So we have, again, n equities, but we specifically look for k factors to explain the data. We specifically assume that there is a residual with certain variance, and this residual is not just some other factors that we don't consider as factors. So it's a step forward in this direction. Unfortunately, it's a little bit of step backwards in the way the factors are identified as what they represent. The reason being is that the factors are unique only up to orthogonal transformation. So if we have a set of factors f1 to fk, we can rotate the factors in a certain way. Let's say f is this vector, and we apply some transformation to the factors. This would not change anything. We're still left with certain factors, and saying that, okay, factor 1 corresponds to say market conditions. It's kind of dependent on the transformation that we apply, and there are a lot of transformations that can be done. The most widely used such transformation is to basically have some ordering of the variances of the factors, which would be akin to what PCA does. But we're not going to go too much into the details. Now, the number of factors is an interesting question, because you actually have to specify beforehand how many factors you're going to look for in the data. This number k is an input. There are statistical procedures to actually find the number of factors, but they work when you actually assume a certain distribution on the original data, which is Gaussian. There's no other way to say it. It's Gaussian. So if you don't believe the original data is Gaussian, you're not really doing anything good when you apply the procedure to find this number k. In practice, what I usually do is apply both methods. First, the PCA, see how many factors the PCA finds. Then apply the statistical factor analysis with that number of factors, and maybe change it by +1, -1, just to see how the model performs, in order to find a good number of factors and with good explanatory power. Another factor analysis that is usually applied in financial data, especially for equities, is the so-called fundamental factor analysis. Now, it's still a regression-based one, so it's still a factor model, just as we had it before in this equation here. But the reasoning and the idea is a little bit changed from the time series factor analysis. In the time series analysis, the data for y was basically like this with yt, and the x's were the time series of certain other factors. In the fundamental analysis, the knowns, what we know about the x's are actually some ratios or data about the companies. Say, for example, what were their earnings during the past year. How large is the company? For example, market capitalization. Market capitalization is basically the number of stocks in existence times the price of the stock. This is a measure of how large a company is. So, whenever you see this is $1 million company, usually this is what is meant. The number of shares in existence times the price gives you the market capitalization. So one of these x's, one of these factors actually account for the size of the company. And it's not in time, but rather the index here changes for a company. So you have 3,000 companies, and the I1, for example, is the return of stock 1. So Y2 is the return of stock 2 at time t, a given time frame. I will be the market capitalization of company I. And what you estimate with the regression, these betas would actually form, because we have here the return, the betas would actually be the returns of the latent factor that corresponds to market capitalization. So you assume that there exists in the market a factor which, when you multiply it by the market capitalization of the company, you get a certain component of the return of all companies. So it's a way to find the time series of the unknown factors. You cannot observe them on the market, but you can imply their returns from the returns of all companies in the universe. And the factors are all kinds of economic and accounting parameters that can be used. The debt that the company has issued, the market capitalization, the earnings, certain ratios based on this and whatnot. And that's it about this lecture actually. This kind of covers the statistical analysis that is usual to perform on statistical data. And what we continue with, wrong button. What we continue is actually a lecture on the system. So this would combine everything we did the last 3 lectures till last Thursday and the one today, and just discuss what the system is, how it performs, and how all of these things before come into play. We'll have some introduction to the system. We'll have some discussions on the actual data management and the actual data visualization. We'll discuss a little bit more about statistical analysis on data, but now not so much theoretical, but rather what actual methods for fitting all the distributions that we just spoke about exist. And we're going to discuss a little bit portfolio performance, risk, and optimization, which is basically answering those questions that we started off with last week. And the way we're actually going to do this, some screenshots from the system, and the main part here will actually be for me to show you a case study that was done, which covers almost everything we discussed in terms of presenting the data, finding the information in the data, and acting upon it, which was kind of the idea of a data mining for financial data. Seeing what the data tells you from different points of view and acting upon it. So yeah, the introductory slide is just what I just discussed. So the Cognity system is basically an enterprise-wide solution for risk management. We want to provide risk analytics to our client based on their holdings in a consistent and transparent manner. We saw the different types of financial instruments that our clients trade last time, and we need to be able to use that knowledge, that financial instruments along with the data in a consistent, transparent manner so people can understand what is actually happening. Now, in the actual application, we can install it in a client's premises, which it's especially important for large banks because they kind of want to keep their data to themselves. So they don't want to share it anywhere, and they would like to have it on their own servers in terms of security. But we also can host it in our own server farms, and the way clients usually access it through is secure channels over the web. So we use HTTPS for the import of data, FTPS, and all the secure protocols for that. The system is actually composed of several different components. We have the UI, which is the front end, and usually the clients operate with this for importing data, visualizing that, seeing reports, running calculation and whatnot. Underneath it, we have multiple calculation servers which actually perform the heavy-duty calculations. So they are data intensive and performance intensive. So we actually have it in such a way so that several calculators can actually run one and the same calculation, allowing for redundancy. If one fails off, we can use another one, allowing for parallelism, for speeding up certain calculations. We also have multi-threaded for on a single server, and so on and so forth. And of course, we actually have the relationship. Well, it's a database relationship. Relational. Yes, sorry. It's not relationship, a relational database. To fit everything together. So these are the components. And the front end, the UI is web-based, so we can actually use browsers for that. You don't have to install anything on client machines, so they can just use whatever they have. And just besides risk management, we also provide portfolio construction and asset allocation, so that out of all these data, people can actually build portfolios as well. Now, where we excel at as a system, this is comparing to our competitors, we utilize better models. We already saw symmetric against asymmetric, fat tail against Gaussian, where the difference, and especially for risk management. But volatility clustering, tail dependence, this is the copula. These are things that most of our competitors are just starting to think about to catch up. And part of the reason is that up until, let's say, 2007, most people weren't that much concerned with extreme events, the so-called black swans and whatnot. You'll see these catchphrases in a lot of places about discussing financial data and risk management. They were kind of content with the normal models. And if you know If you've heard about what happened during the subprime crisis, basically part of the reason was that people were using the Gaussian distribution to model risk. Part of the reason, not the whole reason, but part of the reason for that crisis was that. And afterwards people caught up with that and understood that the Gaussian was not a good choice for that modeling. And you need better models. So that's a big point of the system, providing better models. We also provide better risk statistics, such as the ETL. We discussed that last time, and basically contribution statistic we'll get to them in a while. To add to the ETL and all that. The breadth of financial instrument coverage, we saw a quarter, if I have to estimate. Those financial instruments last time, that long prolonged discussion on financial instruments, that's about a quarter of the assets we actually support. And we didn't really go into the details of almost everything that we do. And a big thing for people they're set in their ways. They think in risk management based on historical distributions or normal distributions. They would like to compare that with the better approaches. They want to be sure that the approach is better. There are academic papers, books written on why the approach is better, but they want to see it from themselves. They want to see it on their particular portfolio, their particular needs, why this is the case. So we actually have to support all the industry standard approaches for that as well. Now, the way we are able to do this is because we estimate risk via Monte Carlo simulation. So we kind of touched base on that last time. We build the model, we estimate the model on the data, and then we produce realizations from that model. And this allows us to see what the distribution of tomorrow's return would be based on past performance and the assumptions of the model. And this is the Monte Carlo approach. And this allows us to calculate all the risk statistics and all the model, because it's difficult, a very difficult theoretical problem to say what the ETL of a given portfolio would be based on the assumption that the risk drivers are stable, for example, because you saw that different financial instruments depend on the risk drivers in different ways. For example, the Black-Scholes option pricing formula depends on some way on the stock price. But if you assume stable distribution for the stock price, what happens with the price of the option? And what happens with the portfolio of options, and so on and so forth. So it's a much better way to do it with Monte Carlo. And the financial instrument risk factor paradigm also comes into play here. Now, in terms of data, we provide some out-of-the-box solution for data. Market indices, FX rates, and different economic indicators, and this is applied with the data. When you become a client of ours, you get this data, and basically it's updated daily. So there are ways to actually pump data into clients' databases. Of course, if they're behind some firewall, it's not really applicable, but for most of our clients, yeah, we can pump data, and every day when they come to work, they have new values and they can work with that value. So here the data issue is somewhat solved. Now, there are about close to 800 factors in this set. So it allows for some breadth of coverage. It's not complete in any sense of the word, because there are far more indices and economic indicators and risk factors that are feasible to be provided for each and every client. But this set kind of covers enough for most people. But of course, this is not the only way that we provide data. I forgot to mention that this data is sourced from different providers: hedge fund research, Standard & Poor's, MSCI Bar, and whatnot. But we also provide ways for not so much ways, but links to data providers such as Bloomberg. We also have others, of course, but the idea here is that these are data warehouses, so to speak, and they provide financial instrument data to all kinds of parties. Traders use Bloomberg, risk manager use Bloomberg, almost everyone uses Bloomberg. And we provide a link between the system and Bloomberg, so you can just type in the instrument that you want to take from Bloomberg and put into the system, and the system will take care of the rest. We'll define the terms and conditions of that instrument, define the import the market data, import the historical risk factor data, so that you can actually use it in the system. And this can be done ad hoc by user request, or it can be done nightly, every night, so that a given set of data is imported and kept up to date. Of course, if you have your own data which you'd like to use, and some people actually do this, they have their own data providers or their own sources of data, some are internal even, they can import it. We usually provide also a service for integration with client databases. But we also have ways, just put the data in a text file or an Excel file and upload it in the system, and it can be used. Now, here we have actually quite a large chunk of information about backfilling and infilling data that we haven't discussed so far. But imagine the following situation. You trade both on the New York Stock Exchange and on the Sofia Stock Exchange. 4th of July is an official holiday in the US. It's not one in Bulgaria. So the market does not have data for 4th of July for the US-based stocks, but it does have data for the Bulgarian stocks. And basically this amounts to a hole in the data for the US, because you either have to ignore the Bulgarian data points, the data points for the Bulgarian stocks, or you just have to assume that there is no data for 4th of July. And with enough such issues, I mean, this is the most common example, but sometimes a stock will not be traded on a given date. There's just no market for it. So data providers will not supply a data point for that data. With enough such dates, you actually start to look at the problem. For example, you want to base your factor model on 2 years worth of data. And because you have to match, you cannot have values for one date against values for another date. You have to match the two dates, otherwise you're not getting the correct link between, the correct regression between them. You want everything to be on the same date. And you just don't have data for this one. So with enough of these holes, you run into a problem of estimating your models. And that's why infilling, which basically amounts to filling these blank points with something, and backfilling, where we actually fill back in time data. For example, given company became public on 1st of January 2012. It doesn't have data for 2011 at all. But we would like to use the equity in our analysis, and we will actually need data for 2011 as well. What to do? We can backfill it. And this is backfilling. So the common term between the two is proxying. and it amounts to finding what would have been the performance had it had data. And it's a very interesting problem because you usually use some market index as a proxy for the performance of the stock, but it's still an interesting problem to estimate what's the link between the true values of the stock and the market index, what would have been the performance on that particular date. And we actually have a lot of methods to deal with this because it's a very common problem. Almost every one of our clients needs something like this to be done. And because there are different situations where different methods work best. One method is best when you have 20 observations and you need 61, so you actually have to triple the data points that you have. And it's a whole different situation where you already have 200 simulation and you need, let's say, 240 for 1 year period. So different methods work in different places. We'll see some examples of that. We also use this method in another setting, and we touched on that in the first lecture. For a consistent treatment, let's say of funds which report monthly and of stocks which report daily, you can't really put them in one calculation as they are. One has a return from here to here, the other one has returns from all of these dates. So you cannot match day-to-day values. You actually have to go and infill daily returns for the fund in some sense. And we do this with these algorithms as well, and they take care of that. We'll see this in a minute. Now, once you import your data, once you've taken care of the way you're gonna backfill or infill it if you need to, usually do, you start your analysis with just exploring the data. And we have a whole tool which is quite large for exploratory data analysis. And we use different visual cues for supplying you with information and, of course, numerical, actually showing you the data and showing you statistics on that data. The visual cues, just plots of the log return, plots of, let's say, box plots. Well, I think I actually can show you a box plot. Have you seen a box plot before? Okay, so you know what the different things like this mean here, and they give a good representation of how we have funds here, but that's just for an example, how different funds scale, and you can actually flip the ordering here by any. This is basically ordered by ETL at 95%. So this one has the lowest ETL at 95%. This has the largest ETL at 95%. And you actually can see how the different funds are ranked, which is better by a certain measure, which is not. You can actually see the spread here. It's quite interesting here. And there are different kinds of graphs and box plots for doing this. Of course, all of these values, the 25 and 75 quantiles of the data, they're available in numerical form as well. You just hit a button and we can show you where the mean is, what is the variance, what is the quantiles here and here, what's the maximum and minimum as well. So you actually see, you can either see it or just read it as numericals. We have kernel estimates of the probability density function, histograms, QQ plots, distribution plots, and all. I think I have examples here as well. So what we have here is a scatter plot between I think this is 10 and this could be 40. No, wait. Scatter plots between two funds. So we have the returns plotted one against each other, and we actually have estimates, two estimates here, of the correlation between the two funds. So we can actually plot what the correlation would be. And the green one would be a classical correlation, the purple one would be a robust one. So the robust one is actually not influenced by this and this. And here is even a more extreme case. The classical correlation would point to about 0.60 correlation between these two, but the robust is somewhere around 0. Because this observation here kind of switch the link between without really adding anything. And this plot here is a kernel density plot. This is basically a way of plotting the probability density function without actually writing it down as a formula. So we have data, and the blue one is actually the probability, the kernel estimate of the density plot. And you can see here there is several observations here that wiggle it a little bit, and some here. And then we also have estimates of two distributions. This is done on top of the density function. We have the normal one, the yellow, we have it here as well, and the stable one with red. And you can actually see how much the normal is dropping the ball here. I mean, I don't really think that it estimates at all what's happening here in terms of behavior of the returns, and certainly not here as well, because there are some returns here which contribute to the loss, which basically have no probability under the normal assumption. So using this way as a stepping point in further analysis is a good way to go. Once you import the data, once you define the proxies, you start just looking at that and seeing whether or not, okay, the normal is not working in this case. I don't really want to see the normal other than for comparison. Maybe I want to use some other measures for correlation based on the robust. Maybe I don't. Maybe I'm fine with this. It depends on your preference in the way you want to go out and define. And then we usually move on to further analysis. And one of the first things I usually perform given a new set of data is just to run what we call one-factor regression, which is, the reason for that is the following. Yes, I would like to build a factor model for my assets, but the factor model is only as good as the factors that are selected. If I put factors that have no bearing on my assets, I'm not doing myself any favors. I'm actually worsening my analysis, because all the meaningful movements would actually go into the residual, because there's not really a link between my asset and the factors I want to use. So I really want to have good factors for my factor model, but if I don't know much about the data I'm using, how to find those factors? It's actually a pretty interesting question. What a statistical way would be to understand links between my assets and the factors if I don't know anything about my data. And one of the solutions would be to run this one-factor regression calculation, which basically takes the assets in a given portfolio and regresses them against each and every factor in the database. So you're actually doing a lot of exploratory analysis on that. So you run one-factor regression. We already saw what that is, and Afterwards, when you see the result, you can actually say, okay, this factor depends on one of these possible factors, and you can then put them in a multi-factor regression and deal with analysis there. But you've already removed 90% of the possible factors. You know that there is no link between your assets and these factors, and you can move on. You can move on basically to a full-blown time series factor analysis as we defined it last time. And here you can actually work with different methodology. Basically, the regression equation, which was, let's put the factors here. We actually need to estimate this. We need to find values with a head that would make this linear combination close to this factor. And we didn't discuss it before, but the usual way people go about in solving this, and actually it's a very old method, is to look at basically this thing, which is the residual. It's the residual squared, and you try to find such alpha, beta 1 and beta 2 so that this thing is minimal. And it's a quadratic problem. You can actually solve it on a piece of paper. You can write it down. It's quite easy to do this. But this is not the only way that you can address this problem. And we provide with the system not only this one, but we have a robust way where we minimize another function, not the square function, but rather something else, phi of epsilon, or the L1 distance-based approach, where here we actually have the absolute value of this. And using different methods, you can compare them, and they would give you different ideas, and you can actually see the results in terms of outcomes, i.e. just what this thing would be, because we have fitted the values, we plug them into this narration, and this would be the outcome, right? Well, let's put that here. And you can compare the true ones with this one and see how far they are. Are there any outliers? Is there something that would suggest that I have left out a factor? And you can look at the residuals as well, epsilon hat, and there are plots on that. And you can compare different methods and how they have done. But in terms of exploring the data, the notion of selecting the best possible factors is a prominent one, actually. And we do it with the stepwise selection. So we can do it for the different methods, but the idea is a powerful one. Let's say out of my 10 factors that came out of the one factor regression, I want to select only those that truly contribute in a multi-factor way. Because, say for example, the 10 selected, one is a sector market index, another one is a country market index, and they are correlated. And you have also the whole market, the world market, for example. You don't really need all three of those in your model. But which one of those three is the best one to explain the equity? If it's a global company, maybe the whole world market is better explained. If it's a company very strict, only working in its industry sector without needing provisions or machinery from other sectors, then maybe just the sector index is the one that you need to use. But that's knowledge which is outside of the statistical analysis. That's qualitative information that needs to be put in there, and it needs to be put by an analyst, basically, that needs to understand the company better. So when you have 100 of these and you only have 2 hours to perform something, you can't really go out and research. So the idea is to have a statistical procedure that would select only those factors that are most prominent in this particular case. So a stepwise regression is one of that. And the basic premise of the model is the following. You start with one factor and you select the best factor there is, and this is your starting point. And then you start to add all the other factors that you have defined and seeing which factor improves the model. So it lowers the variance of the residual, for example, or something else. And then you add a third one, and maybe you then remove another one. For example, if adding these 2 factors is better than having this single one factor, at one point you might just remove this from the equation. And it's a step up and step down approaches to adding and removing factors, and at the end of that procedure you'll be left with the best, in some sense, a statistical sense of course, set of factors to explain your given equity. And this is an automatic procedure, and you can actually run it and see what happens. So it's a good way to actually understanding the behavior of stocks, because this is most interesting about funds. And if you remember, a fund was the general fund is just a portfolio of assets with a manager, and the manager invests in certain assets in a certain way. And the factors used for funds are usually style factors, not so much market indices, but rather factors that account for different style of funds. Let's say distressed equities only, or fixed income arbitrage, or convertible. These are just buzzwords and signifying different ways to invest. But with procedures such as a stepwise, you can actually, and if you run it, for periods of time, you can actually see the change in loadings and the most prominent factors. And you can actually gain information whether or not the managers change the way he invests. You start off with a loading of whatever to one factor, and in the middle of the period it switches to another factor. This is basically an indication that this manager changed the way he invests. And this is information that you would like to know, because this gives you a way either to hedge that exposure or provides you with information that you should be aware of, that this manager changed something. So it's quite powerful approach in this sense, just to figuring out what is happening with the series. Correlation analysis, basically it's a separate calculation in the system, and we calculate the covariance matrix or the correlation matrix between assets, factors, funds, and so on. And we, just as with the time series analysis, we have different methods that we can do this. The classical one, which would be very close to to estimating the covariance of a normal distribution, for example, the method of moments one, our robust method for estimating covariance. So here the yellow, the purple one comes from a robust one. So we're actually removing outliers and finding those outliers. Exponentially weighted moving average is actually a model developed by Riskmetrics for estimating mostly VAR, but it can be applied to correlation metrics, and it's an interesting idea in the sense that okay, let's get some math on the board. I'll show it probably with only one variable, but the same idea can be applied to covariance metrics. So how do we estimate variance for a single variable? So we have observations, and we want to estimate the sample variance. We're actually going to use the maximum likelihood estimate. This is just the usual way to estimate variance. It's the maximum likelihood, so it's not the expected value is not really the true variance, but that's maximum likelihood for you. Now, if you look a little bit at this formula, it actually is something like this. You have 1 over n x1 minus the average. Then you have another 1 over n x2 minus, and so on. And the main thing I want to mention here is this 1 over n. Each observation is weighted with 1 over n, which is the same for each and every observation. And if one is the closest to us in terms of time, so we actually have, if time goes like here, t1 is here, t2 is here, and tn is somewhere around here in the back. Maybe you are not really interested, not so much, you are not interested in what is happening here. Rather, you don't want observations too far in the past having the same weight as yesterday's observation. You want to make sure that yesterday's observation has more weight. It adds more to the estimate than the observation last year at the same time. So what you do, you actually weight them a different way. You have weight 1, weight 2, and weight 10. Of course, you want to have the sum of the weights equal to 1. But the way to actually calculate them, which this is just a weighted estimate. This would be just a weighted estimate for the standard deviation for the variance. But if you say, okay, let's put something like this. Omega I bar would be lambda I minus 1, which would, and just to make it the sum being equal to 1. But the main point is every weight here becomes the previous times lambda. Of course, lambda should be less than 1, otherwise this not really makes sense. But the weight of the first observation with a bar would be 1. The weight for the second one would be lambda, let's say 0.94. The third one here would be weighted with 0.94 squared, until the very last one, which would be 0.94 times n to the power of n minus 1. So this would be really small compared to this one. And this idea basically is the exponentially weighted moving average. And it provides a way just to take these observations which are closer to today with more weight, with more prominence. They're more important for the statistic than this one here. And I hope you get this idea. I really like it as a way of estimating, and you can actually apply it to a lot of things. You can apply it to factor modeling, estimation for factor model. Just what is here would be different, and yeah.
How do you select the weights? Or how do you know that the weights that you have selected are good?
Basically, we're asking how to select lambda. In this case, it's a question of testing. You have to compare different results. For different data, you'll see different lambdas come into play. For example, for equities, it might be best to use 99. For some interest rates, maybe 0.9. And it's a way of exploring the data once more. And it depends on whether or not you're getting good predictions, because the end game is basically not only seeing what the value is, but using that value to have a better prediction for tomorrow. Out of this, we're gonna get simulations for tomorrow's return, and whether or not that is a good estimate for tomorrow's return is, of course, a different story, and we have ways to actually see whether or not this is the case. I'm going to show you some of this, but the general idea is the following. It's called backtesting, and you produce, you start, let's say, 1 year ago, and you use that as evaluation data and produce simulations for the day after. And then, because you know already what happened the day after, you compare that with the actual, let's say, VAR number or at different quantiles. So you're actually looking at the whole distribution of that day's returns with the actual ones. And when you do this for every day for a year, you can actually build a statistical test and see whether or not your model conforms to the way the market works. And in this way, you can actually test which lambda is a good lambda to use. But it kind of really depends on your data and your preference. There's no universal lambda which would work for every kind of data. I also wanted to mention here something else, and it's this idea of Mahalanobis distance. Maybe if we have time. But the general idea, it's linked with covariance matrices, and it has to do with, I'm going to use these graphs here. So each and every point here is a two-dimensional vector, right? x1, x2. One dimension, the other dimension. And this is for time t1, for example. This point here would be x1, x2 at time t2, and so on. Is there a good way to see whether or not these points here in particular are belonging to the bulk of the data, here somewhere here in the center, or they're way off? And the Mahalanobis distance is basically a way to quantify how different these observations are. I'm not going to go into the math, really, because I don't think we have that much time, but we have graphs to plot it. I don't have examples here, but they look something like this. You have time, and you have the distance here, and there is a cutoff point here somewhere. It depends on the number of variables used, and you have the distances here. And sometimes you have something like this. And you actually can see which dates represents points that are too far off from the center. And why would you look at something like this? Because I didn't plot it really nicely, but what would happen if these points were right here, but then something like this becomes apparent? You're actually seeing a shift, and the estimate that you have done for the covariance matrix is taking too much into account these values here, but then the latest values are actually starting to change, and you're seeing a shift in something. And this indicates to you that something is amiss here, and you need to look a little bit more into the data. And when you change the estimation method. Let's say this was done with the classical estimation of covariance matrix. You've seen something like this. You can superimpose a different method, a different covariance matrix on this, and then you'll see that, okay, my other points, they're here somewhere a little bit above the point, but the ones here are okay, and you're fine with that. And you're actually taking into account more this rather than more this. So you can in this way you can actually judge whether or not your estimate of covariance matrix is working for you, and you can actually work better with that. So that's my noise distance for you. The distributional analysis has to do with fitting the univariate models. We discussed them previously. The stable one, the temper stable, the student T. You want to see how good the fit is to the data. So you run this distribution analysis and you see something like this here. And even though this is in the exploratory data analysis, the same plots are actually part of that model as well. And you're seeing how well the different distributions fit the data. Do I need to use one over the other, or I'm just better off with a simpler model, such as the normal, or not? You can compare. You can actually see the values. You can compare the different ones and work with that. So the time series factor model, the correlations, the distributional ones, these are applied on the factors. So we have the factors underlying the financial instruments. We apply this analysis to them because these are the risk drivers. And then we plug them into the financial calculators, such as the option, the bond, and whatnot, and we get the prices for the instruments, which then can take us to the risk. Let's see if I can make this a little bit. Is this better? Hopefully. So this is basically a screenshot out of the system, and I like it, and I put it here because it will help me explain a few things that maybe we didn't cover really well. Here is the structure of the portfolio, and we actually we can skip showing individual positions. What we have here is the portfolio and sub-portfolios that are part of that. And basically the portfolio in this example is split into four parts. So we have equities, which would be the stocks. We have alternatives, which is another way of saying that, okay, these guys are not really common. There are things like real estate. People invest in real estate as well. In hedge funds, private equity. Private equity is basically a firm. You give them money, they give you back in 3 years with some interest. But it's kind of unregulated, and it's mostly used by very rich people, high net worth individuals. We have fixed income, which is further split into credit, which would be debt issued by different companies, and we have rather difficult to see, but yeah, I know what it is. It's U.S. Treasury. U.S. Treasury, basically the bonds issued by the U.S. government. So, and we have some cash here, which is just holding currencies. And this structure of the portfolio, we didn't really discuss that much, but we can. This is all user defined. If they have something else, they can use it. If they want to split their portfolio by bonds that are AAA rated, bonds that are triple B rated, bonds that are C rated even, yeah, they can do that. It's triple B, triple A, C. These are credit ratings. You've seen Standard and Poor, and Moody's and Fitch. They give out these things. So this structure is not fixed. It depends on how the portfolio, and it's also something of a way to look at risk, because what we have here, where is the risk? Well, basically it's here. Here's the VAR estimate, here's the ETO estimate, and here's the ETR estimate. So ETR is the opposite of ETO, so it's expected tail return. This is what drives the gains. So we show risk both on this. Well, let's start from the top. We show risk on the portfolio here and here, and that's meaningful. I mean, you want to know what the risk of the whole portfolio is, but not only that, but we show risk at these levels as well. So the way you split your portfolio will drive the way you are looking at these numbers here. And take, for example, a strategy with an option. You buy the stock, you buy a put option. So you have the option, you have the right, but not the obligation at a certain point in time to sell that stock. So now, because you have both the stock and the option, that you are not gonna see a risk or a gain. It's kept. And if you put that in a single portfolio like this, you're gonna see the numbers here reflect that decision. But if you just throw them in a portfolio along with 100 other bonds, you're not gonna see this diversification effect coming from the option and the stock. Because they work together, you wanna put them in one portfolio. And this is the reason why we can actually split these things here. We discussed what VAR ETL is, so that these are the risk measures. We haven't really discussed what else we can show, but we'll do right now. We have portfolio value. Naturally, you want to know how much money you have invested in your portfolio, and this is estimate that can come from the market prices or can be the theoretical value of the instruments. We have weight information, which is basically this value here divided by this value here. So you can understand that 50% of your portfolio is in equities, 45 here. Oops. We have the mean and the standard deviation of all the portfolios and values. So this is kind of standard for people. They want to see the standard deviation. And the more interesting things are here: incremental, VAR, ETO, and ETR. And this comes into play for the contribution that I mentioned at the beginning of the lecture. So not only do we provide estimates for the risk of the portfolio, but we also can say, okay, if I sell my position in this instrument here, how will that affect my risk? And this is provided by the incremental statistics. So selling my holdings in emerging market equity would actually decrease my VAR, because emerging market equities are rather more risky than, let's say, fixed income or developed equities, which is natural. You stand to lose more investing in Bulgaria than investing in the US. The risks are different. So that's incremental for you. Another question that people usually ask is, okay, I don't really want to sell my whole position. What will happen if I change it by very little amount? So that would basically mean the marginal contribution to risk. So you can think of it in terms of a derivative. You know, the derivative is the change in the function given an infinitesimal amount of change in the variable. Here it's the same idea. Very small amount in the weight, very small change in the weight would produce this change in the risk. So that would be the marginal contributions to risk. And people are really interested in that as well. And out of the marginal, we can build all kinds of other statistics. We can build percentage contribution to risk, which would tell you basically what part of the total risk of the portfolio comes from this position of the portfolio. And I don't have it here in this screenshot, but let's say for this particular portfolio, it would be something like probably 60% of the risk would come out from equities. The rest would be alternatives and somewhat from fixed income, because fixed income basically we have US treasuries here which are considered risk-free, and the system estimates them to be more or less risk-free. What else? We'll discuss this in a bit later on when we come to the other document. But yeah, these are the statistics. We have some other things here in risk budgeting, factor contribution to risk, and sensitivities. But these are all different kinds of statistics and graphs that we can show on the portfolio. Something like this. What we have on the left is a quite simple graph, but it would show the asymmetry of the returns of the portfolio. We have risk, which, for the sake of the discussion, let's say it's value at risk, and we have the confidence level here. And these are basically the quantiles of the distribution. Can you see how asymmetric the return is? 50% confidence level is basically the median. So we are looking at, well, negative risk would basically be a gain, right? So losing minus $3 basically means that I'm going to gain $3. So we are seeing that at the 50% confidence level, we are gaining 1.25%. At the 16%, we're gaining 2.25%, and so on. At the 1% level, we're actually gaining close to 4%, which is not the case for the risk. At the 99% confidence level, we stand to lose only 3%. So there is asymmetry here, and I'll mention that it has more to do with the mean here. So the mean shifts the loss. But if you remember our mind game, the first lecture, where your friend was giving you money for you to play, that's basically the mean. So it shifts the whole distribution of the P&L, profit and loss here as well. This graph here is quite interesting as well. Some math here. When one looks at portfolio optimization, and we kind of mentioned it just a little bit last time, and it was in connection with why Markowitz used the standard deviation, and he established the return and risk of the portfolio. So you need to have risk in order to have return. And this is also used in portfolio optimization. So you're looking at in what ways I can take a little bit more risk so my return will jump higher. And you change the weight of your assets so that you get to that point. But a funny question is, okay, if I'm really good at optimizing without the optimizer and the weights I have in my portfolio are optimal in this sense, what would have been the return that I needed to use in my optimization? Another way to say it, how much return a given asset needs to have in order to justify its weight in the optimal portfolio? And the answer here is the implied return. And we actually calculate that in the system. And it's just, as I said, it's the needed level of return of the asset in order to have this level of risk justified. And when you actually plot the mean returns of the assets here in red, sorry, and you plot the implied return, you can actually compare whether or not the assets have enough return to justify their risk. And we can actually compute this not only for variance but for ETL as well. And for example, this guy here, it doesn't really matter who he is, but his implied return is much larger than his mean return. So basically he needs to provide us with close to 4% for its risk, but he's only given us 0.25% of return. So we may be better off removing him from the portfolio or reducing his weight. Whereas these guys here, they have very little implied return. So they need a very small amount to justify their weight in the portfolio. But they're giving us more in terms of mean return. So we are better off increasing their weight. So this is an example of the risk budgeting that can be done with these things. Stress test. Now, this is again analysis based on simulations, but the simulated values are actually only one value, and the user defines what that value would be. For example, we can actually name them, and they would mean something to people. For example, October 2008, there was a huge sell-off in equities then, and all equities fell down. They lost a lot. So the question people are asking, okay, if October 2008 happens once again, what will happen with my portfolio? So again, you're making kind of a scenario for the future realization of the factors, but you're actually saying, okay, do not fit a model, do not simulate anything, use this value. And people are interested in that, how that thing would affect their portfolios. And we don't actually can see what are the strategies here, but yeah, the blue one, here, and you actually can see for the portfolio the effect is quite small. That's not the case in flight to quality. The flight to quality is a name for you are selling your corporate bonds and buying AAA US Treasuries. So you're moving higher up in the ratings. And the portfolio actually would lose a little bit more when this happens. And by a little bit more, we actually mean 10%, because the scale here is awful. And this particular sub-strategy will lose close to 40% of its value if this thing happens once more. Last slide on this slide deck. this is the optimization thing, and actually we have 10 different calculations on this slide. So what is optimization? You take your assets that you have, your funds or your equities, and you want to find the best weights so that the portfolio that results from these weights have certain properties. For example, it's the least risky one or has the most return. We kind of discussed this last time. And of course, this the whole problem depends on two things. One is what is the actual problem that you want to solve? Is it minimum risk, maximum return, a combination of that, or certain ratio, let's say return over risk? I want to optimize this ratio, so it's optimal in the sense that it's largest ratio, which would mean I'm getting the most return for the minimum amount of variance. So that's one part of the problem. The other part of the problem is how you actually model the assets. And if you take your 50 stocks and model them with a multivariate Gaussian distribution, it actually doesn't really matter if you use minimum ETL as a risk measure or minimum variance, because ETL is for the multivariate Gaussian is just the constant times the variance. So in terms of optimization problem, you will get the same answer, because you're looking for the arguments, the weights that would minimize that function, and the same weights would minimize the minimum variance or the minimum ETL. So the second biggest question in the portfolio optimization is modeling, and of course we have the same with risk. Now, when I say that there are 10 calculations here, we actually solve the problem 10 times here with constraints on the return. This is called efficient frontier. The efficient frontier is okay. Let's have it like this. It's a nice graph, but for explaining purposes, it's probably a little bit better. Yeah, something like this. So we have our risk here. Let's say, this could be variance, ETL, whatever. Well, we have our expected return here, and every asset has some values for both of these, and we can actually plot them. Now, when you form a portfolio, the portfolios, all possible portfolios would form, oops, this needs to be here, would form, for example, a section something like this. So, because the portfolio also has risk and expected return, any portfolio formed out of these assets would fall somewhere around here. And there are no points, no assets that are outside of this. It's strictly here. And then, which would be the optimal portfolios? Well, they would definitely fall somewhere on this line here, because this is, I forgot the English word, this is the edge of the space of possible portfolios. And if we have a portfolio here on the edge, on the frontier, and we have a portfolio, let's say X would be a portfolio. We have a portfolio here and portfolio here. Which one of these portfolio is better? Basically, we have the same amount of risk, but this portfolio returns 1% and this portfolio returns 3%. I'm always gonna choose this portfolio, right? And if we have a portfolio which is here and a portfolio here, the same thing applies. It returns, both return 2%, but this one has 1% risk and this one has 3% risk. I'm always gonna choose this one. So all optimal portfolios fall on this line here. And this is the efficient frontier. This is what we have here. The only thing we lack here is the points where the different assets fall. But for visualization purposes, this is enough. And how you solve something like this? Well, first off, you solve the minimum risk problem, and this will give you this point here. So this is the portfolio with minimum amount of risk. You don't have this can actually have negative expected return. Well, it needs to be positive anyway, but this end of the curve is the minimum ETL portfolio, and this portfolio here is the maximum return one. You don't really, you're not interested in the risk. You solve for the maximum return, and then you space out here, and you calculate minimum risk subject to constraints on the return. So at each point you would like this much return, this much return, this much return, and so on. And you find all these points here. And this here is actually the portfolio you start with. So you have one portfolio imported into the system, and you run a calculation on it. The system tells you that it's somewhere around here, and it should have been somewhere around here if you want to be optimal. And actually the system suggests that you invest like this, because this is the portfolio with optimal ratio. So it would be return over risk, and this is the optimal portfolio in this sense. All the other portfolio have less return over risk. And what we have here are a plot of the weights. So you actually, different colors represent different weights of the assets. And at each point you can actually see where we're getting, what we're getting. And actually looking at this, there is some weight constraint here. No asset can be more than, I would guess, 5% here, because the bottom one is always 5%. So in any point of the efficient frontier, you always invest maximum amount allowed, and the maximum allowed is 5% of the portfolio. Okay, so this is for the slide deck. How much time do we have?
We finished 10 minutes ago.
Okay, sorry. What I wanted to actually show you, I'm not going to spend too much time on this, but let me just remove this. Basically, an analysis for a given portfolio, it's a multi-asset portfolio that two colleagues of mine did actually a while ago. But it's a 19-page document basically explaining a lot of the things we actually covered on this course. And it shows basically what a risk model is, and why we perform time series factor analysis and PCA, and how we get to different analyses. Here we have this is a representation of the different variables that go into a system. Interest rates, FX, equity. I'm not sure if you actually can see this, but let me zoom like this. Is it? Yeah. So we have specific risk, systematic risk, and all kinds of risk variables that would mean something to different people. Oops.
Is it possible to provide this case?
Yeah, absolutely. It's on the webpage of the firm. So
Okay.
yeah, I'll send it along with the slide deck.
Together with the slides?
Yeah. So you can actually see. Yeah, we have. These are some of the plots we get out of the factor analysis model. So this is for the portfolio, and this is for individual strategies. We have FTSE All Share, market index, and whatnot. this is an output of the factor analysis. We have the betas along with the p-values of the betas, and we didn't go into too much details. I mean, it's quite a lot. This is for the PCA. You actually see the explained variance of each component, and this is something you want to see because the first explains 50%, 65% for the second, and 73% for the other. And you see how this goes over all the way here. Script plot, not really interesting. This is an example of infilling and backfilling actually, because these returns are monthly and we would like to use them on a daily basis. So you actually can see how, okay, this is the time period I'm interested in. This only starts from here and it's monthly, and running it for the system, you get infill daily and it actually looks like this. And actually, you can actually compare how you see here variance here is somewhat constant and goes up a little bit, and you can see it in the daily as well. You have some variance here and it goes up once more. And we discussed this, It's a good example for a copula. These are actually observed returns, and you can see how they look like. And if you fit a multivariate normal distribution, you get this. Oops, I'm too quick. And if you fit a copula, you actually get this, which is much more representative of the actual values we have up there. The return and some splits. We have here again a discussion on the incremental, the marginals and whatnot. Some graphs on the percentage contribution, and you can actually compare the percentage contribution to ETL standard deviation with the weight, and the green one is percentage contribution to return, so you can actually see the return as well. There is, yeah, too much.
Thank you very much.
Thank you all for listening to me.
This program is brought to you by AUBGTalks. For more, please visit us at aubg.edu/talks.